Morning. We're calling to order the Deferred Comp Advisory Committee. Today's Thursday, February 26, 10 a.m. Would just like to start the meeting this morning with just a moment of silence on behalf of our valued Sergeant Whelan. Thank you. Roll call, please, Ms. Strange.
Good morning. Roll call. Ms. Goodman.
Present.
Mr. Frank. Here. Ms. Narayan. Here. Mr. Keokum.
Present.
Ms. Regalo.
Here.
Mr. Woolcamp.
Here.
The record will show that Mr. Dollywall is absent.
Okay, first on our agenda is the approval of the minutes for the quarterly meeting of November 7th, 2025.
Ms. Fonte, I make a motion to approve the minutes.
Second.
We have a motion, a second. All in favor, say aye. Aye. Opposed? Motion carries unanimously. Next, we have public comment. Any public comment, Ms. Strange?
At this time, there is no public comment.
All right, then we'll move to the nationwide program status report for the fourth quarter.
Thank you, and good morning. Hopefully everyone is doing well. We'll start with the very colorful handout that was provided. Looks like this. This is the quarterly report that will have all of your plan statistics that we go over each quarter. So we'll start on page 2. We'll start on page 2. It's the plan summary balance sheet. And the top row is where the quarter ended. Gosh, it seems like forever ago, back on October 1st. So that's the beginning of the fourth quarter. The top line is the assets on that date. And then throughout the next few rows, we have money in and money out, fees and loans taken out. And then we have other and plus market gain loss. And so the quarter started at $667 million. You can see the very bottom row finished at $677 million, so roughly a $10 million gain. And then we'll go through the rest of the data. So we'll skip a couple of pages to page, actually we didn't number our pages, apologize. We'll try to do that next time. The page that says participants on the upper left. This shows the total participants with a balance of 7,906. So really close to a new milestone. Hopefully we'll hit that milestone by the end of the year. Fingers crossed to get that 8,000 number, which would be terrific. Right below that, we have average participant balance of 85,950. That was up slightly from the prior quarter, mainly due to market gain and those huge amounts of dividends that were paid during that fourth quarter. With that, we have median balance. That's just the midpoint. And then on the right-hand side, we have Roth usage and pro account usage. So Roth usage, that is after-tax money. So your participants are able to invest either pre-tax or after-tax based on their preference. And there's about just under $15 million in after-tax money. The pro account is fee-for-service managed accounts, which your plan does not offer. Then that little wheel, it shows the ratio of employed versus terminated participants in your plan. So based on assets in your plan, roughly 54% of the assets is held or are held by currently active employees here at the county, and then 44% of the assets held in your plan are with those that are terminated. Next page, a couple of optional strategies. Again, it takes a deeper dive into Roth and self-directed brokerage account. Again, with Roth after-tax money, the little gray box on sort of the top middle, the average Roth balance in your plan is just under $10,000. And the IRS did not allow Roth contributions more than just here in the last few years. So it's a newer money type. So it's not going to be as large as pre-tax. And then below that is self-directed brokerage account. We have a separate handout which goes into more detail, but really just the main numbers. You have about $2 million with Schwab. Your participants are able to invest in a self-directed brokerage account outside of the core funds here in your plan. If they want to, they simply do that. They simply enroll, and then they can transfer money to and from Schwab. And once they're with Schwab, they can invest in whatever they want, and they're going to pay Schwab the commissions of the products that they buy. So those 11 participants that have money in self-directed, about $182,000 average balance, so much higher, about double than what's in your plan, but that's pretty common with our other plans. Moving on to contributions, this is money in right in the middle of the page, current period, we received $11 million in new contributions from your participants during that fourth quarter, those 3 months. Most of it in the form of salary contributions, makes up about $7.5 million. We did get rollovers, some account splits, those are quadros, and you can see the other types of money in. When Nationwide receives assets or new deferrals, you see that little wheel below it. The target date funds are receiving about 55% of all new money, and that's a great number. We're happy with that, and that's diversified. That's a good place to be. So with new money, with again, new deferrals, more than half is going into a target date fund with their purchases. The rest is spread out amongst the other asset classes. Large cap is always going to be usually in second place because they recognize the names of those stocks that are in those mutual funds. And then the others aren't really utilized as much these days, and that's pretty common. People aren't really utilizing balance funds or bond funds, but it's still a good investment option for folks to be in at certain points in their career. Next page is money out. We looked at money in this quarter. We also look at money out. Current period, $13 million went out the door. About 5.6 of that due to rollovers out of the plan. So when your participants are leaving and separating service from the county, again, about half the money is going out in the form of rollovers to other providers, which is very common. And then you can see the other types. RMDs are usually higher in the quarter because most people that are 73 and up need to take their required minimum distribution that's due, and that's an IRS rule. And just about everyone waits till the fourth quarter to take it. And so the fourth quarter distribution count is usually a little bit higher than quarters prior to that, which shows on this page, because last quarter you had about $9.2 million in money out. This quarter it's $13 million. So most of that is because of RMDs that were due to those folks, again, 73 and older. Then moving on to assets, the next page, it's a balance sheet on the upper left. This just shows where current money is sitting. If you look at all of your assets in your plan, about 25% is in a target date fund, even though the plan is getting about 50% of new deferrals, but only about half of the existing assets are in a target date fund. Bonds make up about 4.8%, fixed assets and cash, so this is the guaranteed option in your plan, right around 20% of the assets are there. And then large cap stock mutual funds, you can see, makes up just under 37% of all assets. In the next few pages, we just list all of your investment options. So this includes your largest holding, which is your Nationwide fixed fund, down to your smallest holding. We also list it out by assets, and we list it out by total participants in your plan. And so if there's ever a fund change, then we know the impact of the potential mailings that need to be done. Then just moving on, we're almost wrapped up. Moving on a few pages down to loans. We usually discuss loans each quarter just to show what's happening. On the upper left of the loan page, there's about $3.7 million in outstanding, not to exceed $50,000 for your loan. So they're borrowing much less than they're able to. And most of those loans are general purpose. When someone takes a loan, they can borrow up to 5 years. We have loan modeling software. Also, our call center can model loans with your participants. There's also principal residence loans, and those are up to 15 years, but the participant, again, can choose how many years they want to borrow and to see what the payment's going to be. So not a lot to say on loans, but except that the new loans are growing a little bit. And then just wrapping up with enablement and engagement. Here, this just shows some other statistics that we usually share with the committee. Right in the middle, e-delivery. So these are your participants who have opted out of paper completely. They don't get anything paper from Nationwide, the statements, fund change notifications. Everything is just stored in the website. Online accounts, 68%. That number keeps growing. We've been tracking this when we first took over your plan. I think we were high 30s, almost 40%. So the longer we have you, the more online accounts we're going to have. And Brenda does a great job of making sure when she meets with your employees, when they come and see her, that they have an online account. And if they don't, she'll get them set up. Online distributions, about 3/4 of them are done now through the website versus the traditional paper method, but both options are available. And then upper right, beneficiaries, we have 89% of all beneficiaries. We like to get 100, no plan does, but we're trying to get as many as possible. We reach out twice a year through email, so in February and again in November, if anyone does not have one on file. Again, this is just with us. They might have it here with the county somewhere in a filing cabinet perhaps, but it's best if they have it with us. If they don't, their statement will show that they don't, and we'll have instructions on how to get that updated. Emails are terrific, 93% of all emails we have. And then online enrollment, we had 43 of those last quarter. 29% of total enrollments were done online. And so that number, again, is going to be increasing as well.
John, quick question. On that page in regards to the plan, I know I see that the delivery is enabled. What is the other items? What is the Income America and then the Pro account?
Yeah, so our system and the way that we produce these reports is we have available all of these products that you may or may not be interested in. Some of these would not be a good fit for you. Some of them would, like for example, Retirement Income Builder should be on here, but if it's not, it will be soon. We're going to discuss that today. Income America is a protected retirement product that probably not is a good fit. It's called 5 for Life. It's a guaranteed income product, a little bit more expensive than the one that we've been discussing. Again, probably not a good fit. Same thing with IPP and Lifetime Income Builder, which is being phased out. So we have several versions or different products of lifetime income that we can offer to your employees. We have really 4 of them. Only one is a good fit for you, and that's the one that we've been discussing here. And that's why Eric Linsky has also joined us, and we'll be discussing that here in a few minutes. The other one that you don't have is Pro Account, which is fee-for-service managed accounts. That's something that the county might want to consider. When we transitioned from your previous provider, they didn't have it, and we asked at that time if there was any interest, and at that time, there was not an interest to offer it. But for those people who want professionally managed, or if they want a professional manager money, we have that ability to add that to your plan. It's a fee, and then they would get professional money management on their deferred compensation plan. And again, it's voluntary for those folks who want it. They will pay the fees, not the county. And it's great for someone who doesn't ever want to look at a statement or can't really tell you what a stock or bond is and doesn't care and never wants to look, and they just want someone to help them and do it for them. That's a perfect candidate for that service. So that's something that the county may want to at least revisit at some point, because we think it's a good service. A lot of our plans, most of our plans offer that service. So hope that helps. Mm-hmm. And I wanted to provide a quick Brenda update. I don't look like Brenda or talk like Brenda, but today I'm going to pretend I'm Brenda. So she sent me an email. She's on vacation. She sends everyone her best wishes. Again, can't remember where she is, but I'm sure it's somewhere amazing. But she sent me an email, and she wanted me to provide a few stats. And I'm sorry that these are not up on the screen or in a form of a handout, but I just got it this morning. She's probably emailed me from a beach chair somewhere. And so she wanted me to say that on December 4th, she did a presentation as part of the For Those About to Retire event hosted by S.J. Sarah, the pension system. We had 72 attendees in that presentation, so she was really happy with that. She also wanted to say that we've been averaging 32 for each of the various team webinars that we did in the 4th quarter. So Brenda and her team had 5 different presentations throughout the quarter, all of those in December. So we had a presentation around how to enroll and why, Roth options, which had 42 attendees. We had investment strategies, which had 47 attendees. Tax-efficient retirement income topic had 31. And then we also had one about nearing retirement, and she wasn't able to locate that attendance information, but did have the overall average of 32. And so she wanted me to pass on the fact that she's had a lot of great conversations with your employees, a lot of people interested in enrolling, and also a lot of people trying to roll money out that she's trying to save. And so she wanted me to mention that, but had really good attendance overall on the 4th quarter webinars, so she's very pleased with that. And that concludes comments. Thank you.
Was there anything from the self-directed report that any of the advisory committee members had questions on, or anything you wanted to highlight?
Yeah, happy to. I skipped that on purpose just because I didn't want to take too much time since it's not a nationwide product. But if you look at the second page of the Schwab report, Schwab provides a quarterly report for their clients that have money in self-directed brokerage. They don't provide a full comprehensive list of whatever everyone bought and sold for that quarter, but they do have some general information just in case you were curious. The second page just looks at total assets. It has the average balance, which you already talked about. It has average age, male and female breakdown. It even will break down the various millennials, Generation X, boomers. I myself a Gen X person, very proud of that. So category breakdown, we have some cash. We have very little in equities. So people are buying ETFs, they're buying fixed income, they're buying bonds, and then they're out there buying mutual funds. And so Schwab will break down the top 10 holdings in all categories. And so you can see the mutual fund holdings, the top 10 fund families, and then it also lists out other things. But I'll skip that. Just wanted to see if there's any questions.
Is that an error regarding the $5 and?
I saw that. Yeah, I mean, this is their report. I'm not sure, to be honest. It doesn't look like there's much. It looks like $5. And that could be the case if someone sold, but it's hard to believe that there's $5 in a stock. Most stocks are more expensive than that per share. But yeah, I can check with my Schwab contact and see if that's an error and just make sure that they're aware of it. Yeah. But yeah, that definitely was a standout to me too.
All right, if there's no other questions, then we'll move on to the next item on the agenda. We have the retirement income builder discussion with potential action, and we will ask Vincent Galindo to lead that off for us.
Great.
please.
Thank you very much. A little bit of background before we start. My name is Vincent Galindo. I'm a consultant with Fiduciary Consulting Group. Similar to Nationwide, we're a vendor, business partner. We work in concert with the staff, the committee chair, on really driving enhancements. One of the things that we're tasked with is just being a fiduciary to the plans and, more importantly, the participants. So a little bit of different role. In as much as we're fiduciaries, we talk a lot more about the features and the investments from a fiduciary standpoint, meaning that it's a little clunky, a little bit, but even though San Joaquin County is technically our client, we have one group that we're advocating for, and that's the participants, whether they're employed at the county or not. If they have money in the plan, we're advocating for them, and we take that legal role fairly seriously. We're going to talk about Retirement Income Builder. I see Eric is on from Nationwide, but also Tom Braden. He's head of our research team. Retirement Income Builder, and this was our agenda item, so I don't want to over-explain a product that's not ours, but essentially it is a investment option if the county committee were to choose it, that would be offered to participants in the plan. It does provide some safeguards, but when we, as a firm, took a look at the legal documents, there were some concerns. We have talked about this, I believe, the last 2, maybe 3 quarters, and so I think it's nice that we have Tom and Eric on the line to talk about the features and potentially some of the drawbacks of this product. So I'll pause to see if anybody has questions, anything they want to add.
Question. I know that it's a fairly new product, but the concept has probably been around for a long time. Has anybody actually, wouldn't say completed it, has anybody actually withdrawn from this product? Or or we're still waiting for the batch of individuals to retire in the future before we actually see it happen?
Yeah, so the question, Eric, is have any of our clients withdrawn from, you mean, so they've adopted RIB and then opted to cancel it? Is that
No.
Sorry.
They went into the income builder, they purchased the income builder product, and now they're retired, now they're collecting a check from it.
Yeah, no, the answer is not yet. No, it hasn't been around yet long enough. The first round of people who are going to be eligible for distribution is in about 2 years. So that's when we'll have our first people who are eligible to start taking distributions if they choose.
Other questions? Madam Chair, should we talk about the concerns that we have, or do you want to tee up or at least provide a refresher of the product, or how should we proceed?
So I guess I think the one thing I would want to, especially for our new members, This was something that the committee approved, and then we actually learned of the concerns and kind of halted the implementation of it. And so we currently aren't communicating to our employees that this is something that they can access, and we wanted to resolve that before we move forward and ask Nationwide, to implement it fully. So, I think the concern that, all the other experts are going to be able to explain it much better, but I think our concern really was that while it looked good, there was some concern about if, one of the concerns I think was a little bit continuity if we no longer were with Nationwide. And then also the other was if this product went under, I believe. There was a concern about how it would impact the members. So we have discussed this at several of these advisory committee meetings, and really where we think we'd like to kind of have the consultants really provide us some guidance here, some information, some options. I think one of the things we may want to think about is do we continue to feel comfortable moving forward with this, or is it something that we would prefer not to fully implement and actually formally indicate that we wanted to not move forward with the product?
Until it's vested for some time.
Yeah, and until we have either more historical information, or if there's some change in the way it's designed so that those overarching concerns are addressed. So. And so maybe Tom could kind of share. I think there was one or two highlight issues of concern that Morgan Stanley brought to us. And I will say that, there's been a lot of discussions with Nationwide as well. And so we're just trying to make sure that we have all the information we need to make a good decision on behalf of the participants. So.
Tom, do you want to kick off?
Okay, very good. Thank you for allowing me to speak with this group. I'm Tom Braden, Director of Investments at the Fiduciary Consulting Group. Vincent and I have worked together for some 10-some years, just past 20 years in industry. But as for this product in particular, Eric can describe very well its functionality and its purpose. For products such as these, what we always do as a consultant is, in addition to reviewing the promotional explanatory materials, there's usually some contract or declaration of trust or offering circular or something to that effect that gives the particulars of how it functions, which is what we always have to read through, because that's usually where the questions and doubts start arising. So in the case of this particular product, and before I go to our particular concerns, I'll back up and say and mention that the criteria for products such as these is it's not like a large cap growth fund or some other kind of product where there are more easily obtainable spare parts, if you will. If one breaks down, you replace it with another and such. The individual product, we have to have confidence it's going to function for decades, ideally like 30 or 40 years without incident, in order for participants to get the proper value from it, because for the first 10 or 20 years, the value of the product it's essentially just returning your capital to you before before it really pays out the benefit that you purchased it for, which is a hedge on longevity risk, the risk of outliving your assets. So with those, I would say higher standards in mind, when we dig into the product, a couple of the things that first jumped out at us is it is not an annuity product on the participant level, meaning normally if a participant purchases an annuity, and this is done in several other products, retirement income products that we've evaluated by several other competitors, if they purchase one through an asset manager like a BlackRock or a Vanguard or State Street or what have you, they have an annuity contract, an individual annuity contract, and those annuity contracts also receive some amount of state guarantee. And that's an additional thing that we find to be reassuring, and other law firms that have opined on this have said the same thing. This product is, when we read through the contract, it tells us that participants are not beneficiaries of an annuity contract. We validated that with Nationwide and confirmed they are not individual annuitants. The contract is between the trust company that oversees it, Global Trust Company, and the applicable insurance company. So that view of the guarantee, they are still guaranteed by that insurance company, but that backstop is not there as we see in so many competing products. So that's one of the that was one of the most fundamental concerns that we don't expect to happen on a year-to-year or even decade-to-decade basis, but over 4 decades is something that we think is material enough for us to basically pause and not continue. In addition to the lack of backstop, which is more of an issue in terms of credit risk, another issue that we found is the ability of the underlying insurers to terminate the payment, and that language is provided in the contract. Terminate payment that the insurers are making to the participants if certain conditions are not met. For example, if the retirement income builder is unable to provide information reporting and certain other requirements to the insurers may suspend or discontinue payments for them. So in our minds, we think, well, I doubt that will happen from one day to the next, but again, over a multi-decade time horizon, that very well could happen, and that could coincide with someone in their, in a retiree who's, 90 and expected to live to be 80, and their defined contribution assets are already depleted, and this event happens. It seemed that again makes the long-term stability of this product too tenuous in our minds. That's another one of the guarantee aspects of it that gave us concern. In addition to that, were also questions of portability as well. So again, over 40 years, it's not that we expect the county to, that we have any expectation of who will be the record keeper for the county in 10, 20, 30, 40 years from now. But in the event that it no longer is Nationwide, and again, Nationwide does a fine job as a record keeper, the product in its current form is not highly portable across the suite of the main players in the public sector defined contribution space. Nationwide is there, Transamerica is there. We believe others are on the way, but at present, it's not a very robust suite of competitors. So in the event that the county elected to move to another provider, this product in its current form would not be able to, it's not certain to be able to port to the next one. It's designed to do so, but in practice, we do not see that it is ready to do so in such a case. In such a case, participants, they can set up an individual account sponsored by, I believe, by Nationwide, though the fees on that account are substantially higher. So those are more of our long-term stability and reliability questions, concerns that we have, to say, nothing of the value of the product or the competitive landscape. I work on a focus group with broader Morgan Stanley, including its outsourced chief investment officer office, its global investment office, and a couple other offices to vet products such as these. And I can say with confidence there is a good suite of competing products in this space that do not carry the list of concerns that I've just elaborated on. And then again, that's of course to say nothing of the value of the product vis-a-vis a variety of alternatives, such as sticking in a target date fund or simply sticking the money in cash, and how long a participant is expected to live for before the value of the product kicks in. So we have kind of longer comments to elaborate on, but I thought in the interest of time, it'd be best to kind of get to the heart of our concerns. So with that, I will stop and invite questions or further direction.
Any questions from the advisory committee for Tom? All right. And it looks like Eric would like to make some comments.
Yeah, if that's okay. Just want to touch on a few points that Tom mentioned. I think that one of the unique components of Retirement Income Builder is that it is structured so that participants don't have to annuitize, and I think I would say that could be argued as a strength of the product compared to a lot of the other products out there that Tom referred to, where ultimately they do kind of require your participant to annuitize their assets. And in doing so, they actually have to pull the money out of the account, out of the plan to do that. Whereas with retirement income builder, because they don't have to annuitize, they're able to leave the assets in the plan until they start to take withdrawals. So I think from a plan retention standpoint, retirement income builder is a unique product that helps address that. And ultimately, too, the structure where they are not having to take an annuity also was by design. It was designed as a strength of the product because you do have this trustee, this GTC is the trustee of the product who oversees it on behalf of the participant. So, so they are legally required to look out in the best interest of a participant. So if something were to happen to an insurer, some situation where they would have to jump in, the participant then has a fiduciary organization, that being GTC, looking out on their best interest, whereas in a retail annuity, they're having to do that on their own. So some of those points I think were designed within this product intentionally as a way to actually strengthen it and making it more appealing for plan sponsors to consider.
Okay, it looks like Tom also would like to make a comment now.
Thank you, and I'll try to refrain from excessive hand raising, but just to point counterpoint, these the variety of competitor products I'm referring to, none of them have the requirement to annuitize. They have the same optionality as this product does as well in terms of fiduciary oversight of the selected insurers. Each of these products I was referring to as well have that same capacity, and I would add a robust selection committee vis-a-vis, peers such as GTC and others. So I don't want the perception to be that that flexibility only exists within this product. It exists within a good variety of competing products in the marketplace. So thank you, and I'll again refrain from the excessive hand raising.
Mm-hmm. Right. At this time, Vincent, I don't know if you have anything else you want to share, if we want to provide an opportunity for John, if there's some overall kind of suggestions or options you may want to.
No, I think between Tom and Eric, today's as well as past discussions framed it very well.
Any questions? Any other questions? I know that we've discussed it a lot. I mean, one of the big advantages is that money is leaving your plan to buy annuities, and Brenda talks about all the time. I mean, there's $1 million account holders that are staying put because this could potentially be added. Otherwise, they're going to want to buy an annuity outside. And when you buy an annuity, you give up your money to an insurance company, and then they give you a future promise to pay you a lifetime income. This product is nice because it stays in your plan, and it's great because it conserves assets. All the fees are paid by the participant. There's no fees to the county, but it's a great tool for retention, which is the main benefit of it, which is why it's such an attractive thing. And for those folks who are new, this is a guaranteed lifetime income product where if you put some money in it, you get a guaranteed 6% for life. And then when the equity portion runs out at some point, if it ever does, then you're going to get a guaranteed 4.5% for the rest of your life. So it acts kind of like another form of a pension for those folks who want to set up lifetime income. So it's a good product for those folks who are afraid they're going to spend their money and go through it too quick. It happens. People, once they get down to their last dollar, their account is gone. And there aren't many products like this in the marketplace, and this is one that can guarantee that their account really will never run out. So they're going to get paid for the rest of their life. And so we love it. We think it's a great thing for your employees. There is some interest in it, which is why we've been discussing it now for a few quarters. Any other comments, Eric?
No, just happy to answer any additional questions that come up.
I just have some comments. Again, I think this is a great product for the private sector that doesn't have a pension. I remember my wife working at CVS. You know, she's subject to the stock market, so this would be a great product for them. With that being said, you know, I think it's kind of a new product. I'm always the type of guy that wants to see someone else go through it first before I jump on there. So I'm not saying that it's completely. I wouldn't completely go for it right now, but I think we want to look at it a little bit longer. I do understand that the downside of it is saying, hey, people are leaving our plan to go do this, and I like the idea of having options for people too. But again, I'm just really cautious about moving forward with it. Again, are we having 50% of our plan leaving for this product, or are we having one person leave for this product, two people leave for this product? Again, I'm just not that comfortable yet with it, and I know you're talking about a guaranteed 6%. You know, that's that kind of, I wouldn't say it scares me a little bit, but you know, I probably want to take a look at a deeper dive into that mark there. So those are my comments.
I think I would just want to add that, you know, I think the county workforce does depend on this committee and our consultants and our record keeper to make sure that we're offering things that are, you know, kind of trusted and tried and true. And I liked the idea because I think we all know, especially for our tier 2 members, pension members, that, you know, there are going to need to be some more creative ways to look at their retirement planning. And so I think that's what really kind of caught the eye of the advisory committee, is that, you know, there's something that we can offer that could really help people ensure some security in their retirement. But learning about some of those drawbacks, to me, it just makes me feel like I would be reluctant to allow, you know, to put it out to employees and have them join in, and then it end up being something that, you know, really, because without that individual guarantee, I think that's what really did concern me, is that, you know, it could just not, at a time when they need it the most, not have it there available for them. And that was the concern for me.
I'd say it'd be great for tier 4 members when there's a tier 4 that doesn't receive a pension. I think it'd be excellent for them.
So at this time, do we have a motion or potential direction from the advisory committee?
I'd make a motion to just monitor the product, and again, revisit it in a year.
I'll second that motion.
All right, we have a motion and a second. All in favor, say aye. Aye.
Aye.
Opposed? Motion carries unanimously, 6-0. And thank you, Eric and Tom, for all of your work. I know you all have spent a lot of time helping us understand this better, and it is really very much appreciated.
Thank you as well.
All right, we'll now move to the fourth quarter performance report from Vincent.
Great, thank you. So hopefully in front of you, you have a fairly thick report. My desk is in Portland, and I think we're rich in trees, and so we attempt to drown you in paper. I grew up in Woodland. About 25 years ago, I met a woman from Oregon in my first day of my job in San Francisco, and we moved up to Oregon. But even though, as I said, my desk is in Portland, most of my clients are down here. I still consider the Sacramento Valley my home. So it's good to be back. As I said, our role is slightly different than Nationwide's in that we talk a little bit about the economy, then we talk about the markets, and then the investment options, and we go through the plans. Go ahead and flip ahead to page 4. I do want to talk a little bit about this mediocre economy. Mediocre is sometimes a good thing. And so when we take a look at what we saw in the headlines in the fourth quarter, a couple things jumped out. One was the longest, at 43 days, the government shutdown. So a lot of these economic indicators that I'm going to talk about at the bottom of page 4 were either delayed, or some economists are viewing them a little side-eyed. The other thing too was the 2026 contribution limits were delayed, and there was a hit to GDP. And so when we talk about the economy and GDP, I'm on the number on the bottom left. Gross domestic product is a good measure of our economic activity. We did see a fairly robust third quarter of 4.4%. It was revised upward. The print is 4.3, but it was revised upward a little bit. And then we had a softening fourth quarter, and that was driven partly by that government shutdown of a GDP print of about 1.5%. And so we are seeing a sluggish economy, except for the American consumer. We as American consumers do a really good job of buying things. We set a holiday record last year in '24. We eclipsed that in 2025. For the first time in November, December, we spent over $1 trillion. And I've talked about this before. Maybe it's with money that we don't have, because credit card bills are continuing to tick up. And I talked about the BNPL feature that we all seen when we buy things. What is BNPL? Buy now, pay when. Lot today, later. So companies like Klarna, Affirm, and PayPal are doing fairly well because 20% of internet consumers are using that option to do what I grew up with called layaway, basically paying at a later date or installments. In fact, about a month ago, Affirm partnered with a company called Isuzu, not the car company Isuzu, but Isuzu. Tenants can now select pay rent and installments. So I think this whole subscription/installment feature is not going to go away. But nonetheless, we are doing fairly well in propping up the economy, except for that softening in the fourth quarter. On the jobs front, the bottom right, we do track the job numbers as measured by the unemployment rate. A measure of full employment is an unemployment rate of 5%. We haven't seen a number that high in a number of years. You can see the 4.4% in December actually is 4.3% for January. So the number is going down. I bring this up not to set the stage for the economy or maybe to depress you, but more to set the stage for the markets. Generally speaking, markets like lower interest rates. Cost of capital is lower. We continue to buy more things. And in 2025, the markets did very, very well. And so if you flip ahead to the next page, page 5, bottom half chart, second line down, I'm going to start with the boring bond market. Sometimes boring is attractive. The conservative fixed income marketplace, as measured by the Bloomberg Aggregate Bond Index, typically averages maybe 3.5% over a full market cycle a year. Take a look at last year, up over 7.25%. So fairly impressive returns out of that conservative bond market index as represented by the ag. The news continues to get better. Down about halfway, you'll see the large cap equity. This is the US stock market as represented by the S&P 500. And these are 500 large US companies, and they're typically household names like Tesla, Apple, Microsoft, et cetera. But not coincidentally, those names I read off, these big companies are tech companies driven mostly by artificial intelligence. And so those companies have done very, very well over the last 12-month period, except for maybe the last 2-month period. There's been some struggle with investors questioning the capital expenditure commitment on these tech-heavy artificial intelligent names. But nonetheless, you can see the S&P 500 up almost 18% last year. And then the news gets better around the globe. Second line from the bottom, the international equity is represented by the ACWI, the All Country World Index minus United States. There are about 45 countries outside the US with an investable stock market. So Brazil, Japan, Canada, Mexico. Look at that 12-month number, up over 32% year to date. I did peek because the 2026 year to date number is also fairly impressive. As of yesterday, the ACWI ex-US is up 10%. And when I take a look at the emerging markets, so just bear with me because I think it's a little antiquated view of the globe, but MSCI carves up the globe in 2 spheres, if you will. One is the developed markets like Western Europe and Japan, and then there's the developing side, so like Latin America and Africa. Those developing markets are more tied, the economies are more tied to the commodity index, and those sectors have done very, very well. The economies have participated, and the emerging side, year to date, is up 12%. And so big difference between the 10% number and the 12% on the emerging side. But there's also a part of the commodity, precious metal. You have a precious metal fund on the menu. I don't know if you peeked what the performance is. Anybody want to guess what the Special mineral fund was up over 100% last year. So we'll get to that in a second. But flip ahead to the next section, page 15. This is the executive summary, if you will, of both the 457 and the 401A plans. You can see the market value upper right, about $685 million as of year end. The broad split of the asset categories, you can see in the pie chart, about a quarter in the navy blue fixed income, over a third in the gray portion, the large cap. Those are those household names like Nike, UPS, et cetera. And then the target date models is in that gold slice. And then the other asset categories are small slivers, and you can read that there. Pivoting from right to left under plan notes, just anything worthy of note to call it out. At a previous meeting, the committee voted to replace the Vanguard International Value Fund with the Hartford International Value Fund. That happened in middle of November, as well as that move to the lower cost collective investment trust. And so we did see some cost savings on the target date side in the middle of November as well. The investment policy statement was last updated. We do have the charter as well as a fee policy on the agenda, and we'll talk about that. And then from a vendor management, we call out anything worthy of note. As you can see, there is none at this time. And then on the bottom third, any funds that are giving us pause, either from a quantitative or performance or a qualitative, is going to be called out because we'll place those funds on watch. You'll notice that there are 4 funds that are giving us a little bit of pause. The MFS Midcap Growth, the Vanguard International Growth, and the DFA Real Estate Securities. All 3 of those were placed on watch. The good news is for that DFA Real Estate Securities Fund, you can see the performance is improved and no longer violating metrics, or as you can see in the report middle column, it's in compliance as of this quarter. But according to the investment policy statement, we like to see 2 consecutive quarters of compliance. And so my cloudy crystal ball is we'll be able to remove that fund from watch status at the next meeting, but we're not quite there yet. The investment gold and special mineral, this is the fund that was up 139% last year. It's not a performance issue. The lead manager decided to leave. And so anytime that there's management change, we've seen the movie before where sometimes it's a disruption, sometimes it's not. But given his role in the fund and the process, the fact that he is left, our recommendation is to place the fund on watch. And that's why it's a qualitative reason, not quantitative or performance. So let's take a look briefly at the 457. I like following John because he covers a lot of data points, so I'm not going to be repetitive, so I'll skip a few pages. If you take a look at page 17, focus on the bottom half. This is the weighted return of the investment options in the program. Again, this is the 457 plan. Last year, the navy blue column, or 1 year, the investment options returned over 13%. Fairly close annualized over 3 years, you can see 13.5%. And then annualized over 5 years, a little bit less because of that fairly weak 2022. You can see 7.75% annualized over 5 years. And then on the next 2 pages, speaking of the investment options, as a participant, this should look fairly familiar. On pages 18 and 19, all the investment options on the left-hand side, we group them roughly by asset class, rank them generally in risk order, so, but definitely with ending balance. And then you have under specialty that real estate and gold and special mineral fund. At the bottom, you can see $640 million in the 457 plan. And then this is a nice growth on page 22. Taking a look at the top half, you can see way back in 2020, there was just under $500 million, significant growth in the plan over the last several years, ending the period of about $145 million. Again, discounting a little bit of that 2022 where inflation hit a 50-year high, the Federal Reserve aggressively raised interest rates, and the stock and bond market were off double digits. But what's also nice to see, and this is kudos to Nationwide, probably Brenda and staff, second line from the bottom, way back in 2020, there was 6,200 participants. At the end of the period, almost 8,000. So again, fairly nice growth in participants And then the 401A, a much smaller plan, but similar return characteristics on page 24. You can see over the 1 year, just under 16%. Over 3 years, annualized at 17.75%. And then over 5 years, 9% on average every year. And then pages 25 and 26, as you can see, second line from the bottom. And then on page 31, this is the somewhat intuitive, maybe high-level overview of the characteristics of the funds. On the top half of 31 are the actively managed funds. Bottom half are passively managed funds. On the next page are the target date models. But I want to focus back on 31 and the two right-hand columns. What we do is we take a look at the metrics in your investment policy statement, screen them against the characteristics of the funds. If there are no issues, it's going to show green or maybe bluish green or maybe blue. If there's an issue, it's going to show red, and that's the trigger for watch status. And from a fiduciary standpoint, a little bit of background, the reality of fiduciary law in California is it's not about the outcome, it's about the process. So if there's ever a challenge, whether it be from the IRS or a participant suing us as fiduciaries, we're going to have to defend not necessarily the outcome, but more the process. And so having a good process goes a long way of providing fiduciary relief to us in the room as fiduciaries. And so part of that is the watch status. We monitor all the investment options, but especially the ones that are on watch. We're on constant contact with those fund managers. And so you'll notice that MFS Midcap Growth was placed on watch about a year ago. Vanguard International Growth was placed on watch at the last meeting. DFA Real Estate is on watch, but no longer violating metrics, so there's no red dot, but we're going to give that another quarter. And then that Invesco Gold and Special Mineral, given the management change, is showing red under qualitative factors. And then back to my point, if you can flip ahead to page 38. Bottom, the second light blue row, this is the performance. As I said, over 130% last year. This is where it gets very, very interesting. The light blue row is the performance over different time periods, net of the fee. The gray portion is the peer group ranking of that manager against other precious metal managers. And you can see that fund was not only up over 130% last year, but it finished in the 81st percentile. That means over 80% of fund managers in that category perform better or more than 130%. But nonetheless, taking a look at the 10-year performance, up 21.5% annualized and 19th percentile. I'll take that. Way back in 2021, it was first percentile. And so as much as I hate an 81st percentile ranking over 1 year, I tend to focus more on the longer term performance, especially in this category where there's going to be a lot of volatility. But nice return for participants who are invested in that fund. Hopefully not all of their money is in that fund, because diversification over the long haul is important. From a fee section standpoint, next section, next page, page 40, every calendar year is represented on page 40 in a column, and each column has 3 colors. The light blue portion is the investment cost. Participants are paying this directly to the fund managers. The navy blue portion is what the committee collects to pay for plan-related expenses like training, consultant, legal, et cetera. And then the orange portion is the revenue requirement that Nationwide needs to administer the plan. Staff a call center, send out statements, pay for local on-site rep in the form of Brenda. And then if you flip ahead to the next page, I want to focus on that light blue portion, the investment cost. On pages 41, in the top half of 42, second to right-hand column, these are all the expenses of the investment options. And again, those options are on the left-hand side. The expense ratio is on the second to right column. And these are unlike a lot of fees that we pay in our everyday life. They're a little bit hidden, or some say sneaky, because the fund manager simply deducts his or her fee before reporting the performance to you after their fee is collected. So all these performance numbers are net of the fee, or essentially after these are taken out, but they add up. On a $640 million plan, I'm on the top of 42, light blue row, 32.7 basis points or 0.32.7% is just over $2 million. So our job as a fiduciary, or more importantly as a consultant, is to report any cost savings to try and lower that cost. But keep in mind, we're not trying to buy the lowest cost investment options, but fees are definitely part of our equation. And so you can see the $2 million on the investment side, but then there's that additional tack-on fee of 5.75 basis points. I'm on the second chart on page 42. Remember, Nationwide collects 0.2.25, we round up, 2.25 basis points. That's about $144,000 a year, $36,000 a quarter, or $18 per head. And then there's the additional tack-on fee of 3.5 basis points that the plan, or you all as a committee, can use for plan-related expenses, and that's about $224,000 a year, $56,000 a quarter, or $28 per head. I'm bringing this up now because even though it's a future agenda item, I think the context is very compelling. As I said, we lowered costs by moving the target date funds managed by T. Rowe Price. I'm on the bottom quarter of 41 and the top half of page 42. You'll see the expense ratio is 37 basis points. That was a savings, so good job there. But there is an opportunity to lower that cost to 29 basis points. And the annualized savings is about $135,000 by moving to the 29 basis points. I'm bringing this up just for comparison as this optically is in front of you now. But more to come on that in a minute. So questions on the 457? The expenses on the 401A are very similar, so I'll be super brief. 44, those charts should look familiar. Light blue, investments, navy blue, plan-related budget, and orange, nationwide fee. And then you can see the accounting on page 46. $38 million plan is paying about $125,000 in investment costs. The 401A, nationwide is charging about $9,000 to administer, and there's about $13,500 in plan-related budget that you can use for the 401A program. And then probably most importantly, the page 47, we track all of that budget or the administrative allowance, if you will, that the committee can use so that you know to the dollar what that budget is and an accounting quarter in, quarter out. So in the last quarter, fourth quarter, we started in that pool of money, $58,420. Again, we collected it from participant accounts, about $77,000. There was a little bit of growth, but then there was distributions to pay plan-related bills like NAGDA, like consulting fees, and then you ended the period just over $77,000. And this will continue to change just like it has in the past. Questions, comments on that?
Vincent, I have a question on page 34.
Okay.
As a new member, I have great materials on everything, but I have to admit, the first thing I did was go to this report. I was just curious, the top performing fund. Before I went through this, I thought, okay, it's going to be the Vanguard S&P, right? And I was surprised that it was that T. Rowe Price, the Russell 1000 Growth Index.
Mm-hmm.
So 2 questions. Are these fees, like the 10-year numbers, or is this gross or net of fees?
Net.
Net.
Correct.
So even though T. Rowe is actively managed and the Vanguard one is not, it's still better returns. So there might, just any thoughts on the markets, on why? I just would have thought in my head, S&P 500, it's going to have a higher correlation to the big 7 than the 1,000 companies versus 500. But I guess just the growth stocks have just outperformed. So just if you had any thoughts on that.
Sure. Yeah. So, and I'm looking, because I'm glad that Tom is up here because he can chime in as well. But so you brought up the Magnificent Seven, or the 7 top stocks, sorry. And those are Microsoft, Apple, Tesla, NVIDIA, Google, et cetera. You talked about the S&P 500. You would think that with 500 companies in the S&P 500, one company would be worth roughly 1/500th. It's not. In the S&P 500, As of year end, those top 7 names made up 36% of the S&P 500. It gets worse with the Russell 1000 growth. They made up over 50%. So in essence, the Russell 993 made up 43% of that index. And so in 2025, those 7 names propped up the market hugely. Year to date, as of yesterday, the S&P 500 is up 1%. The equal weight S&P 500 is up 6%. Because those 7 names, what goes up generally comes down, and they dropped over the last couple of months, where everything else, the broad rally with the other S&P 493, if you will, has continued to rise. And so that's what's driving the 2025 numbers. But year to date, I'm guessing, or even the first quarter report is going to look, I want to say different, maybe very different. Yeah. But T. Rowe Price, their management across all platforms has been fairly solid as long as I can remember my 20-year career. Tom, never mind. I'm putting you on the spot. Anything to add?
Honestly, you did it better than I would, Vincent. I think that's a solid representation. Yep. And the question is apt. It's pretty much the growth investment style over the trailing market style being strongly in favor. But at this point, the top 10% of the Russell 1000 growth are about 61% of assets. So a turnaround in even just one or two of those names on the back of a hot market will drive them down, as we've seen year to date. I didn't need to say all that, but I think you said it better than me to begin with, Vincent.
Good question. Other questions? So one of the things that we typically get, Amazon, that's the other 7 I forgot. The other question I get is really, what do we see the markets this year? I think essentially a lot of the administration policies are driving some of the volatility in the market. We certainly, over the last 3 weeks, we saw appointment of Brett Matsumoto, Commissioner of the Bureau of Labor Statistics, heads up more of the job numbers and that sort of thing. And so more to come on that. But I think the even bigger news is the appointment of Kevin Warsh, Chairman of the Fed. Jerome Powell, who's the current Chairman of the Fed, his term is expiring. Kevin Warsh, I think from a policy standpoint, gets an A+ from a lot of economists. I think the one overhang, though, is the administration's encouragement of them being consultant on interest rates, or basically the independence of the Fed is being questioned. But keep in mind, the chairman is just one vote of, Tom, correct me, FOMC, 19 votes, 12 votes, something like that. So
I think it's 12, yeah.
12, yeah. So there's 19 heads, but then there's 12 voting members on the FOMC, and those cycle through. The fact that the administration is pushing for reliance and consultation of interest rates, I don't know if it's necessarily going to go anywhere. I think the independence is going to be maintained, but we'll see. We'll see if Kevin Warsh is appointed and really what happens. But nonetheless, when I look at my cloudy crystal ball called the futures market, there's 2 interest rate cuts expected in the market. The first one starting in June and the other one in the fall. And I think generally, as I said, markets like lower interest rates. And so more to come on the rally, but hopefully we'll see.
All right, so I think we need to take a vote on the new funds to put on watch. New fund, I should say. Any questions from the advisory committee for Vincent about the reasoning for that, putting the Invesco Gold and Special Minerals Fund on watch? Can I get a motion?
I'll make a motion to place the Invesco Gold and Special Minerals Fund on watch.
I'll second.
All right, I have a motion and second. All in favor, say aye. Aye. Motion carries 6-0. All right. All right, so next I think we went over the fee analysis as part of the presentation there. So I think the next thing was to have a discussion on the lower cost collective investment trust.
So this is a little bit headier than just simply saving $130,000 because I want to set the stage to frame the relationship between our firm and you as a committee, the chair and the county. because it's fairly typical. You have a discretionary relationship over the administration of the plan. We do not. Meaning we come to you with recommendations and pros and cons, have a discussion, and then you make the decision, and Nationwide generally executes those on your behalf. If we were to move to the 37 to the 29 expense ratio on the lower cost collective investment trust, not only would participants save about $130,000, but it would significantly change the relationship of our firm because it leverages a unit in Morgan Stanley, given the multi-billion dollars that we call OCIO, or Outsourced Chief Investment Officer. We would adopt fiduciary status and discretionary authority of just the target date models. So let me just explain that. Right now, as I said before, we're a fiduciary. We have to make recommendations that benefit the participants in the plan. We're legally bound by that. That does not change. What would change if you were to adopt this is we would have discretionary authority, meaning that we wouldn't come to you necessarily with a recommendation. We would have the right and the ability to make changes to the target date funds on our own because you granted us that authority. And that's one of the requirements by leveraging that OCIO relationship, so you can move from the 37 basis point fee of the target date funds to the 29. So because that represents a significant change in the relationship, a lot of our committees are saying, let's think about it like a lot of other weighty decisions that you have. But our fee doesn't change. We don't have an incentive. We're still a fiduciary of the plan. And just having done this for 20 years, the fact that there's going to be a significant enough change at T. Rowe Price and the target date funds where we're going to make a swap is probably super, super, super unlikely. But it could happen. So that's the one thing. And I go back to the point about the process. The fact that this is agendized, even if you don't adopt it, if in the future a participant says, you had the opportunity to lower my costs and you didn't, you could say, we talked about it. And if you decline it, just like almost every other feature, at the risk of asking the same question, hoping for a different answer, we're going to agendize this so that it's reflected in the minutes and so that you as a committee are always aware that there's an opportunity. And you said it's not worth giving up the discretionary authority on this side of the room to this side. So,
Vincent, can you give some examples of when you would exercise that discretion and make a change?
So again, it would have to be, given the fact that these are broadly diversified portfolios in the name of the target date funds, it would have to be a systematic breakdown in T. Rowe Price's process, management team, implementation skills, things that are so out there in terms of reality or possibility, but those would be it, is that there'd be just something broken with T. Rowe Price and their process, is when we would make a change from T. Rowe Price to Vanguard or BlackRock or State Street.
So essentially giving you the authority without having to, a quicker response time. and
Right.
Having to wait for approval.
Yeah, but and this is where I frame it, because just with our other discretionary clients, we never make that change in a vacuum. Communication is key, especially communication in advance. So what we do is whenever we make a change, even though we have the right to, we come to the committee and say, this is what we're seeing in the near-term horizon. This is the rationale. Just want to get buy-in. We have the right to make the change yesterday, but we're coming to you because it's not really an emergency, but communication and participant disruption are a lot more important. So it's just something to keep in mind.
Just a question, Vincent. Is there any other providers that have the CIT product, or are you guys the only one? Let's say if you kept your same fiduciary duties, but you just outsource that portion of it.
So most of the other target date providers have a collective investment trust or CIT version. So Vanguard, BlackRock, Tom, I'm glad you're still on the phone. Most of them have a lower cost collective investment trust version, right? Not just T. Rowe Price.
That's correct. Yeah, Vanguard, BlackRock, T. Rowe Price, American Funds, State Street, TIA, I think Fidelity, I think that's the list, but that's most of the industry as well.
So at this time.
Meaning that if we if you just chose to if T. Rowe Price fell out of favor for whatever reason, we have a pretty broad suite of alternative suites that we have these same advantageous relationships with that we could switch to under this authority.
I like the idea of saving money, and I appreciate what you said earlier, Vincent. If there is some issues, you'd be in communication with us early about things. I think, again, obviously we hired you as a fiduciary, so we do expect you to let us know if something is going sideways and stuff like that. So I would make it a motion to approve the moving the target date series from the low cost CIT to a lower cost CIT.
I'll second.
All right, we have a first and second. All in favor?
131,000 a year.
Opposed? Motion carries. All right, and next on the agenda is to talk about our committee charter and fee policy.
And this goes back to fiduciary trust law in California. There is nothing in the code or in the federal code or the state law that says we have to have these governance documents, but they certainly represent not only fiduciary best practice for process, but also for protection as fiduciaries. So one of the questions, I think, one meeting a year ago, there was a discussion around if the chair can't make it, who serves in their stead. And so we started talking about drafting a policy around membership, roles, responsibilities, and that sort of thing. And so that was the kernel of having this charter where it just spells out a lot of these things, selection of the membership, et cetera. This is certainly a boilerplate from us that was reviewed by staff. And so with that, I don't know if anybody has a chance to review it, or Madam Chair, if you wanted to opine on the document.
Yeah, I think, I think the one thing that, I found when I came into this role is that I was looking for some roadmaps that weren't there. And so I think that this is just helpful for history and continuity to make sure that there's an understanding who serves on the committee, I think was one of the things. I will say, unfortunately, based on the passing of Sergeant Whelan, it did raise to us that we may need to make an amendment here and that we didn't really address what happens for an unexpected absence. And so we may, obviously, for those who serve by their position and role, like our treasurer, tax collector, our auditor, controller, county administrator, that's, we expect somebody to be, placed into those roles. But for the participants, we may need to make some administrative change on that just to identify how how those seats would be filled if there's an unexpected absence before an end of a term. So if somebody resigns or so.
So this is a brand-new policy charter, it's not
Correct.
amended from, okay.
Just a couple comments. I'm not sure when we want to make it effective. I know one of the things that jumped out at me was the designation of an alternative representative. It's item number 2. So I guess I would appoint someone, and I'm pretty sure this says, it reads, the designated representative should be appointed at the first meeting of each calendar year to fulfill the role for the entire calendar year. And then again, I'm going to assume that that's to fill the designated alternative role and not my role for the entire year.
So I think that the way it is drafted is you could designate somebody for the entire year. So if you just thought that you didn't want to come to these and participate with us, that if it was something that you didn't have the time or ability, that you could designate someone else to take your place.
Maybe it was an absence or something
Do
like
we
that.
have the ability to designate somebody, like, let's say I couldn't make one particular meeting? Would I have the ability to designate somebody to go attend in my place for that meeting alone, or?
No.
No, okay. I would just be absent.
Yeah.
That's what I thought it was for.
Yeah.
Where if I'm absent, my assistant will come in and do it.
But no, you're saying if we designate somebody, they literally take our place.
Place for the year.
Oh, sorry.
We take.
Sorry, Robert.
Oh, okay. Okay, I'm gonna let Oriana jump in because she's.
Yeah, so I'll chime in, sorry. I think actually was when we were discussing it. Sorry, we've done a lot of policies lately, so you'll have to excuse Jennifer's already trying to retire on us. So the designated representative is to serve as a proxy for a member who isn't able to attend even a single meeting. So the reason we decided to have one person be that person that you designated at the beginning of the year was so there was continuity and they kind of had an idea of what was going on. So whether you invited them also to attend some of these meetings or watch them virtually so that they could sort of be in the know of what's happening. So if you aren't able to attend a meeting, that we were giving them the authority as that designee to be able to step in your place. And for the designated representative for that time period, it would need to be somebody like your second in command, essentially, in your office. So it needs to be somebody with some higher level authority. And that person, you would decide who that is. Obviously, we're not doing it at this first meeting because we're just creating this. So maybe it's something we agendize for the next meeting where people can name their designee. But ultimately, that is so that if you are on a beach somewhere like Brenda, then you can have somebody step in at that time.
But from what I'm hearing, you're saying that person will step in for the entire year, or is it only for that meeting?
It could be both. I think that.
Okay, I see what you're saying.
Yeah. And
I just
if
didn't
we
wanna- I
need
just
to
didn't wanna-
alter some of the language, and I think that we're bringing this to you guys, and this is your first round seeing it. So it could be that we go back,
So,
make some changes to it, and
after the advisory committee, whatever is agreed on, if it's today or at a next meeting, it will then go to the Board of Supervisors for formal adoption by the Board of Supervisors. So if there is, if the only question or concern is related to the unaccepted absence, I would request, and if the committee is comfortable with the rest of the charter, then I would request that a motion be made to just have me make that amendment, and I can certainly share that with you before it goes to the board, but not have to wait for the next advisory committee. If there's other issues or questions or concerns, we'll certainly address that when if we need to bring it back next quarter.
I have no other questions. That is the only item. Again, if I'm absent, I would hate for my assistant to have to take on the other 4 meetings. But if I am absent, I would like him to be here if he's available to listen to what's going on and kind of fill me in, and then we'll make the decision later.
we can
I
tighten the
apologize
language.
for making it more convoluted than it is.
and mostly so that we don't run into a lack of quorum.
Correct.
Right.
Issues if a couple of
Exactly.
us happen to not be there.
The other piece is if we're going to do that motion where we're changing that language, maybe adding in some content too around the amendment that we were talking about to include that in there. So with those changes, and we'll work with council again to get the right language in here to build this out.
I will make a motion and approve the changes to adopt the charter with the amendments, allowing the HR director to make those changes.
I'll second the motion.
All right, we have a first and a second. All in favor, say aye.
I'm sorry. Can we get a little bit more clarification
Yes,
on
ma'am.
that motion as to what changes the HR, what changes the HR director is being authorized to make?
I'll make a motion to adopt the committee charter and to allow the chair, the plan administrator, to make amendments to the designated alternative representative as what we discussed in regards to a replacement, and also to make amendments to include a resignation from the committee.
And Greg, are you okay with that revised motion?
Fine with that revision.
All right, so all in favor, say aye.
Aye.
Opposed? Motion carries. Thank you. All right. And then we also had a fee policy for consideration.
One other document that serves as fiduciary best practice for documenting the prudent process, but also just providing guidance to staff, the committee, and the chair is a fee policy. Essentially, the first half of this articulates some of the reasonable / legitimate plan-related expenses that you might cover. One of the biggest questions is, okay, we're sitting on $77,000. What can we spend that money on? And for good or ill, the IRS offers very little guidance other than as long as it benefits participants. And it gives you wide discretion for you to prudently say that this expense, whether it be food at an enrollment meeting or sending staff members to the NAGDA conference or paying the consultant, you have that final authority. And this just articulates some of those bona fide expenses. And then on page 2, just outlines a process of if you're not generating enough revenue to pay your bills or the plan-related budget, or more often is the case, if we have excess revenue. So if we're mirroring the plan-related budget and now there's, let's just say $1 million in that bucket, what do you do? And so this just provides guidance on really direction for the committee, timing and process on what to do with that. There's nothing that mandates this. It just provides not only that guidance, but fiduciary relief. But here's the other thing too, is just like every other governance document, we need to follow it. There's nothing worse from a fiduciary standpoint that you have a policy that's outdated, so we'll update it, or that's not followed. And so this will provide a nice roadmap for all of those. With that said, you might have a different opinion, and like the charter, this is your document, subject to any of the edits that you may feel justified.
And if I could just add that one thing that staff has discussed on this is that we will be asking our budget person in HR once a year to come and discuss the fees and how the budget is looking and how those fees are being used.
The only thing I ask it is if we could possibly get it to mirror like this. It has no page numbers and it doesn't have like Roman numerals to identify, like Roman numeral 1 payment of administrative expenses. If we could just add those to it, so if we're addressing an area, we can easily call it out.
Certainly. Any other questions or entertain a motion?
I was gonna say, wait, are we, okay. I make a motion to approve the fee policy as presented.
I'll second. And Mr. Joaquin, if you can just, you consider the change.
With the editorial modifications to add the numerical indication for each section.
Just looking at you.
Okay, we have a motion and second. All in favor, say aye.
Aye.
Aye. Opposed? Motion carries. Thank you. All right. All right, next on the agenda is to talk about 401A plan county contributions. Me too? I know. It's all about Vincent today.
Okay. What time's your flight? So let me just set the stage, because once I explain it briefly, hopefully this makes sense. In the corporate world, and I'll use these numbers just because they're easy to do the math. Let's say the contribution limits in any given year is $10,000. I'm working for a private company. I have a 401k. My employer contributes some. I can put in the full 10,000. My employer puts in 2,000. I get actually $12,000 in my 401k. 457 land is very different because there are two different codes or sections of the code. It's a little bit crueler in 457. So back to the same scenario, $10,000 limit. I put in some money. My employer puts in $2,000. That $2,000 is counted against my cap. So I can put in only $8,000 in the 457. Again, it's a little bit rough, but we polled 29 California counties and we asked a couple of questions. Is there a county contribution? 17 said yes. Do you have a 401A? And so we were working with staff on really ways to optimize participant features in the retirement program here at the county. Right now, the county contribution goes in the 457, and the downside is it caps participants' ability to maximize their savings. Of the 17 that have a county contribution and a 401A, 3 put the money in the 457. That means 14 put the money in the 401A. And so we wanted to bring this to your attention, and I'll turn it over to others to continue, of maybe shifting that county contribution from the 457 into the 401A. Now, there's some potential trade-offs because they're different sections. The 457 has a nice feature that I can take money out early, if you will, with no 10% penalty. That's not in the corporate world. So there is that early withdrawal penalty. The 401A does have that because it's under the 401 code, not the 457. But generally speaking, it does offer a lot more flexibility at the participant level if you were to change it.
Vincent, I'm assuming there's no additional fee increases for adopting this?
Definitely no hard dollars. I'm trying to think just the trade-off of that early withdrawal. There's no real downside.
Do you mean for administering the plan? So one thing, just to give a little bit of background and context, we currently have a 401A plan. Our physicians are the ones that use that plan, right? So general staff don't typically contribute to that plan either way, whether it's our employer contribution or their employee contribution. There are 2 separate annual limits for 401A and for 57B. So having those 2 annual limits gives higher wage earners, those individuals who are contributing a lot to those plans, it gives them the opportunity to be able to max out, cap out at both. So that's one of the enticing things about the shift. One of the other things is, even though you can't withdraw early without the penalties, the purpose is to have people have their money sitting there for retirement and not just drawing upon it all the time. So with my fiscal hat on, for me, I feel like being fiscally conservative in that way for employees, it's actually giving them a little bit of benefit because they will have something to hold on to when they are done. Right now they can withdraw, we see the loans, we see everything coming out of the 457B. 401A wouldn't necessarily have that same level of flexibility without those penalties. And so we want to just be, if we're trying to be good stewards of our resources and really prepare our workforce for retirement, then they need to have something sitting there in retirement, right? So that's one of the other reasons. We have had this question from a few people, especially as we've been recruiting, and we're recruiting high-level individuals, high-wage earners. There is always this conversation and question about the contribution limits, right, for the ballers out there that have the money to max out both. So it's just one of those things that has been an interest from individuals, so it wasn't something that we just kind of broadly thought of. And I know that Vincent talked about, the 29 different counties that have this. Currently, there are only of those 29 counties, there's only 4, including us, that do our contributions for employees to the 457. All the other counties are pretty much contributing to the 401A. And it would still allow employees to do their contribution to the 457. So the employee contribution would still sit in the 457. They would now have access to an additional plan for the 401A where our contribution is going. And really, that's our setup for their retirement. They can do with what they want at any point in their history, right, for the 457, but we're saying this is going to be for you upon retirement age.
Yeah, again, I think I brought this up maybe the last meeting. My wife works for the VA. Her contributions, like you said, goes into 401A. I brought that up to you, and you said it's a simple check of the box. I just wanted to make sure it's not costing us any additional funds for the few that would be utilizing it. And what I'm hearing is it's not the case. So I really appreciate you guys bringing this back. I think that's a big bonus. Probably should have done this probably a while back. I think this is excellent.
So question though, is this, if we elect to adopt this, it's not an across the board, is it that every county contribution for every participant goes to a 401A? Or is it only if we individually select that option?
It would be wholesale. Any county contribution would move it.
Okay, so this would be every single participant that's in the plan right now, if we adopted this, would start getting a 401A?
Correct.
Okay.
And
No.
so they would keep their money currently that's in the 457 that's been
Yeah,
contributed up to
that
now,
would
and
stay.
anything that we decide to administer it.
So this would be for the employees who receive a county contribution. So not all
Okay.
employees receive a county contribution at this time. And so it's for those bargaining units that do have a county contribution, that county contribution will move into the 401A. It is something that we've talked about from the broader perspective of over time being able to have more situations where we have a county contribution for more employees, you know, when we can afford such things, to help encourage and drive people to participate in the 457. So that will just free it up. And, you know, obviously not all of our employees are providing contributions at the maximum rate, but for those that are, it just provides another option for them to be able to expand it.
We would also have, so employees would still contribute to 457. So right now, 457 is open to everybody. That doesn't mean that everybody gets an employer contribution. So it would only, like Jennifer said, it would only be those staff that get the 401A plan added. Everybody else would still be signing up for the 457B who don't have that employer contribution to their plan.
And those future contributions in the 401A, it would be in the same funds that they're currently invested in their 457?
Yeah, I mean, it can be. We can just mirror the 457 and then simply enroll them in the 401A, but you can invest completely different. There are two different IRS codes, two different products. We record keep them. You'll have one statement, but you can change it anytime. Yeah.
And I think the 401A, if I was looking, is doing a little bit better, yes, than the 457 plan is right now.
Only because the participants in the 401A are allocated different or invested differently. And so probably a little bit more aggressive, benefiting from higher markets. Yeah. But it's the same investment menu. But you're right. Yeah. Good observation. Yeah, it's those physicians.
Wicked. I think.
And if I may, the 401A contributions, if this were adopted, those individuals who are interested in doing the catch-up contributions, they can contribute at a pre-tax basis. Is that correct? If they're the high wage earners.
And they're within the age range of having.
Correct.
Yes, because there is no Roth
Correct.
/ after tax in the 401A.
Correct.
Yes.
Whereas if we were not to get this 401A, those people would be in the 457 and they would have to contribute to a after-tax Roth IRA.
Correct.
Motion? This is probably the best thing I did on this committee right here. I was like, I make a motion to approve the 401A plan county contribution.
I will second that.
And so Ms. Regallo has thirded it. Motion is second. All in favor, say aye.
Aye.
Opposed? Motion carries. All right, so next on the agenda, we have Oriana to provide some updates.
And just to close that out real quickly too, we will work with Nationwide to figure out a date for that, when we will initiate that.
And communicate it.
Yep, and send communication. All right.
Sorry, so one more thing. So overall timing on this, it's more payroll based. We can amend your 401A agreement, probably I'd say 2 weeks at the most, and then we need a signature. So that's on our end. And then payroll will just need to make sure that they're able to send those contributions to the 401A and not the 457. There's a little bit of payroll intervention happening here, but so a couple balls in the court. So one's in ours, one's in payrolls. Our side, a couple of weeks. We just need to get instruction via email on what to do, and then we can amend that agreement, and then we can work with your payroll team to make sure that the files are sent correctly.
Thank you.
My payroll team will be thrilled.
We love to make changes in the payroll system. It never causes any unexpected impacts at all. Yeah, exactly. All right, so Oriana, do you want to go ahead? We've got a little over time, but if you want to go ahead.
Yes, I will talk. I can talk fast. That's what I do best. All right. So one of the things that I wanted to bring up was the November meeting currently is scheduled for Thanksgiving, I believe. Um, so having these on the fourth Thursday of the month. So we need to set a different date. So I would ask folks to look at their calendars and see if, I think we had identified, was it the 19th? So the 19th, 13th is Friday. November 19th as an alternative date. Does anybody have any conflicts with November 19th that would be an issue if we, you do? You have a conflict?
I have two other committee meetings that day, one in Marin and another one down in, I have to be in two cities at once, so, yeah, I cannot make it. But we can have possibly Greg Saban attend, who is our program director.
Okay. All right. We'll miss you.
Yeah.
Is that Calpera
Is
time?
that Cal Power?
Okay. So then the 19th would not work. All right.
Greg's gonna be at Cal Power.
Whose idea was it to shift the meetings?
Right.
It was not a
The
good one.
12th.
Sorry.
The 12th is another, November 12th. That's the another Thursday before. So you guys are in Santa Clara.
How long is the drive to from Santa Clara?
I think
We can
la-
do the afternoon. Our Santa Clara meeting ends at noon, so.
Exactly.
Unless,
Yeah.
yeah, virtual, but.
Does the afternoon on the 12th work for everybody? You'll send your alternate, you designate. New policy already in motion.
San Jose to here, 2 or 3 hours.
Okay. And do they need to vote on that?
Yes, we do. We have a motion to change the November 2026 meeting to the afternoon of November 12th.
I make a motion, we change the date from November 26, 2026 to November 12th, 2026.
I'm trying to think at this time, how long is it? I'm doing a quick math.
Yeah, Santa Clara.
No.
Yeah. Yeah, it's pretty.
2 to 3.
Think so?
Hate to be late. Sorry, we're just working out logistics.
No, that's okay.
We happen to be in the same meeting that day, 10 to 12.
Oh,
So,
yeah,
so right
yeah,
now it's
can
an
we-
hour and a half.
could they come in virtually? Yeah, well, let's just have you guys come in virtually.
Yeah, so I think, why don't we set it for 2 PM, and then if it turns out that
If you
it's
can
not going to work, you
if
can
it's-
jump on.
yeah, dial in from the car.
Don't pull up the off-ramp.
Pull out, look at page 48. Okay. Did we do the motion already? Is that done?
We had a motion from Mr. Frank. Is that correct? We need a second.
This
All
is
in
Fonseca,
favor?
second.
All in favor, say aye.
Aye.
Opposed? Motion carries. All right.
All right, and I'm going to go up to the front for this part, just so I can. So, a while back, I stepped in to support the EEO Advisory Committee. There were a lot of things happening on the committee where they felt like they wanted to be more of like a working committee. They really felt like they wanted to do more than just see numbers and be a little more active and interactive. And they also wanted to be a lot more visible. So one of the things that we did was developed an EEOAC board members webpage. And so this webpage, if I can use your mouse, are you left-handed? What am I doing? Okay, thank you. So one of the things that we did was we created a web page for the EEOAC, and all of the board members sent in a bio and a headshot so that members of the community could recognize them. Okay, you're gonna have to drive. So there's their headshots and their bios, and they got to send in their own bios to us with their photos so that we can get them on the webpage so that they can sort of be recognized in the community. People know who they are. They know that they're a part of the advisory committee. And then if you go up to, so on the page, if you go to the home, go to the, sorry, about, yeah. So one of the things that we start off with on the page is sort of the mission statement, the vision statement, what is the EEOAC? And it just gives an opportunity for people to sort of understand what the responsibilities are for that committee. And then if you go to, we just saw board agendas and meetings, all of our agendas and meeting minutes are on here. So even you as advisory committee members, if you say, oh, what was that meeting that we had that one time, you can go back and there's a resource to be able to access that. There's also a calendar on this so that you can go in and see when the updated meetings are. So when your next meeting is. And then can you go to the one that, and go to theirs. So the wonderful RDJ helped to develop a page for the Deferred Compensation Advisory Committee. So it kind of just talks a little bit about what the advisory committee does. There are some nationwide forms on there, things that people may want to access. And we will continue to build upon the site. So right now, under board members, you guys have the lovely, like, lorem ipsum idor with your photos not yet intact, but we have who you are and your role. And so one of the things that we're going to ask is for you guys to send us a photo and bio so that we can get this updated. It's not active yet in the community until we've got all your information. But we wanted to just have an opportunity for a resource for you all as committee members to be able to access documents, but also for people in the community to know, so we're a little more visible. I think we do a lot of good work in here, and so we want people to be able to easily access. We'll also make sure to start like linking the link, right, to the meetings themselves so that just like when you go to the board meetings and you click on the link for the board meeting that's happening, it would have the most recent link for these meetings. And then again, all the agendas and minutes would be listed on there as well. We have, Shadell sent a bunch of the older minutes over and the agendas. So we do already have some, like a year or two back, I think you sent Shadell, something like that. So we do have some content on there already. Any questions, comments, concerns?
I like the idea of having the minutes and the agenda out there. Kind of on the fence in regards to the bio and the pics, and I'm assuming that we have many other advisory committees in the county. Is everyone going to get to put their resume out there and their picture too? I know that we were just talking about. Sorry, I know we were just talking about this committee, but that would be my only concern. So I'm not sure how the rest of you guys feel about that.
And there is that option. So some people, like on the EEOAC, you could see that somebody still has the shadowy picture because they didn't want their photo up, but there's just a little bit of content. And it doesn't have to be your full resume. It's whatever you really want to say. Like, I'm on this committee because I really enjoy trying to better our employees equip them for retirement. It can be whatever that you want to put on there too.
So I do know, like, the retirement board obviously has photos. I don't think they do bios, but they do at least identify who the members of the board are.
But again, I think those guys are, I wouldn't say more just making decisions versus an advisory board. So again, at the end of the day, we could advise all we want. You're going to make the final decision. I don't know. Again, I'm not. I'm okay with it, I guess.
You're shy. You don't want your photo up there. It's okay.
I just don't need it. No, I'm not worried about the photo portion. I mean, I remember there was a time when we did have a department head, and he put his hey, learn more about me, and it was basically a resume out there. And I think that at that time, we the county, when I was in the office, kind of frowned upon it. So I don't know. Again, I'm not sure how you guys feel about it, but that would be my only concern.
Yeah, and you guys can absolutely opt out of the bio photo piece. We don't have to necessarily have that part on there if that's something that the committee chooses.
So I think that the important thing to me about the page is that we think about what members are interested in. So I do think the link to the board meetings, the agendas, and the minutes are really important. And maybe we can just list who's on the advisory committee and their, their roles without the bio piece of it, if that's.
Kind of how it's listed in the charter.
Yeah.
Yeah, just a table of who's there and what their role is.
Yes.
We can absolutely do that. The reason the EEOAC had it was because they had a different framework in mind for what they were looking for, but 100% we can take that part off. It just makes Rob's job easier.
I think we should just have one picture for our council. It's important that everybody knows who our council is. Joking.
It really is like.
Thank you, Oriana.
All right, let me turn this off and. So the next thing on the list is calendar. So one of the things that we also want to start doing is making sure to have some level of, we already know we do certain things each year, and we decided to start doing a yearly advisory committee calendar with some of the topics that would happen in any given meeting. So some of those sort of annual report outs. We always do our quarter investment performance review, and our annual review of the investment policy would happen once a year. The NAGDA conference happens once a year. So this is really just a document that will kind of outline and give you guys some information on some of the things that you can expect in any given month so that you don't send your designee if it's something that you care about deeply. We do have on here like the report on the allocation of revenue from HR in August. So that was something that Jennifer had just discussed, was that is something where HR will come and do a presentation every year in August around that, the revenue stream and the report on the allocations from that. So we were just trying to highlight other things that happen annually that just make it easy for people to sort of know about ahead of time. You'll see that the NAGDA conference in 2026 this year is September 27th through 30th in Orlando, Florida. So we're also going to be asking you all to send us your interests. So if you are interested in that, we can start budgeting for that. Yeah, so this is the calendar for the year. And if there's anything else that you feel like it would be really good to know or hear about this, either at the meetings or annually, you can let us know and we can try and figure out the best ways to build those in as part of the plan.
Sorry, Robert. I assume most of you in this room already know this, but I have announced my retirement at the end of June, and so you will have me for one more advisory committee meeting, and then you'll have a new plan administrator. So I just wanted to make sure everybody was aware. You will need to take that up with Mr. Goodman. All right, if nothing further, then we'll go ahead and call the meeting adjourned. Thank you.